Imagine a product so powerful it generates profit without producing anything tangible. A product so invisible that most people don't even realize they are buying it every single day of their lives. That product is debt. And far from being a neutral financial instrument, debt has been deliberately crafted into the most profitable product in human history. It has funded wars, toppled empires, enslaved nations, and quietly drained the wealth of ordinary people. And yet, ask most people where debt came from, who designed it, and why it dominates our financial system, and they couldn't tell you. Welcome to Invention Studio, where money meets history and exposes the financial engines running the world today. If you're serious about understanding how power really works, make sure you subscribe to Invention Studio. The story of debt is not just an economic history, it is the story of money and power itself. Debt, in its simplest form, is a promise. You borrow today and agree to pay tomorrow. But in that promise hides the core of financial control: interest. Charging interest turns the future into profit. For thousands of years, society struggled with this idea. Ancient Mesopotamians recorded debts on clay tablets, but they also periodically wiped them clean in debt jubilees, because leaders knew that when too many citizens were trapped in obligations, the system collapsed. In the Hebrew Bible, debt forgiveness is commanded every 50 years. The idea was simple. Debt was dangerous. It could enslave entire populations if unchecked. But fast forward through centuries of history, and you'll see how elites learned not to erase debt, but to weaponize it. In medieval Europe, the Catholic Church officially banned usury, the charging of excessive interest, yet merchants and bankers found ways around it. They disguised loans as trade contracts, or created complex credit instruments that looked like anything but a loan. By the Renaissance, powerful banking families like the Medici in Florence built empires not on land or armies, but on lending. They financed kings, popes, and merchants, and in return received not only money but political leverage. Debt was becoming more than a financial product. It was the engine of power. The real transformation came in the 17th century with the rise of state debt. When the Dutch Republic fought for independence from Spain, it raised money by selling bonds to its own citizens. Investors could buy government debt, receive interest payments, and trade those bonds like property. Suddenly, war was no longer limited by the gold or silver in a king's treasury. It could be financed indefinitely by selling the future. The Dutch perfected this model, and soon England copied it. The creation of the Bank of England in 1694 formalized national debt as a permanent institution. Instead of borrowing from individual lenders, the state borrowed from a central bank that issued notes backed by those loans. For the first time, government didn't just raise debt in emergencies, it lived on it, rolling it over endlessly. And the bankers who managed this debt became indispensable to the crown. Debt had graduated from private contracts to the very foundation of state power. The profits were enormous. Lending to governments was the safest bet in the financial world, because governments could raise taxes to pay their creditors. Wars that once would have bankrupted kings could now be financed indefinitely. And those wars, in turn, expanded empires, opened new markets, and created more opportunities for debt. It was a perfect loop. The more nations fought, the more they borrowed. The more they borrowed, the richer their creditors became. By the 18th and 19th centuries, the bond markets in London, Paris, and Amsterdam were the beating heart of global finance. Armies marched, ships sailed, colonies were conquered, all on borrowed money. But this wasn't just about nations. As industrial capitalism spread, ordinary people were drawn into the cycle. Railroads, factories, and infrastructure projects were built on credit, financed through bonds and bank loans. Workers earned wages from companies funded by debt, and then they themselves borrowed to buy homes, tools, and eventually consumer goods. Debt seeped into every layer of economic life. By the 20th century, debt wasn't just a tool of governments or tycoons. It had become the everyday products sold to the masses. Mortgages, car loans, credit cards, student debt. The entire architecture of modern life was constructed to normalize borrowing as the default condition of existence. And here's the hidden genius, or the hidden cruelty, of it all. Debt doesn't just create profit once. Every interest payment is a transfer of wealth from the debtor to the creditor, from the many to the few, repeated month after month, year after year. Unlike a product you buy once and use, debt is designed to be permanent, to lock you into a cycle of payments that never truly ends. A house bought with a 30-year mortgage will cost 2 or 3 times its sticker price. A credit card bill rolled over month to month can grow faster than your ability to pay it. What began as a promise becomes a trap. Debt, then, is not just a financial arrangement. It is the most successful business model in history. It requires no factory, no inventory, no raw materials. It generates wealth out of time itself. And the ones who understood this earliest, the merchants of Amsterdam, the bankers of London, the financiers of Wall Street, became the architects of the modern financial system. This system doesn't just manage debt, it manufactures it, expands it, and depends on it to survive. By the middle of the 20th century, debt had stopped being a tool used only in emergencies and had become the lifeblood of the global financial system. The Bretton Woods agreements of 19 were celebrated as a new era of international cooperation, institutionalized this reality. The International Monetary Fund and the World Bank were founded to lend money to nations in crisis or development, but behind the lofty rhetoric was a simple mechanism: debt as discipline. Countries could borrow, but only on terms dictated by their creditors. The IMF, dominated by the United States and Europe, began attaching structural adjustment conditions to its loans. Entire national economies were told what to cut, what to privatize, and how to reorder their budgets. Debt wasn't just profitable, it became a lever of political control. Nations that borrowed too much found their sovereignty compromised. Their policies rewritten, not in their own capitals, but in Washington or Basel. The rhetoric was about stability and growth. The reality was dependency. At the same time, a quieter revolution was happening in the daily lives of ordinary citizens. In the decades after the Second World War, banks discovered a way to sell debt, not just to governments and corporations, but directly to households. The mortgage became the crown jewel of middle-class aspiration. Owning a home, once reserved for elites, was suddenly possible for millions, but only by signing a contract that chained families to 30 years of payments. Car loans, furniture installment plans, and eventually the credit card transformed debt into a consumer product marketed like any other. The psychological shift was massive. Debt was no longer shameful or rare. It became the normal way to participate in prosperity. Buy now, pay later. Enjoy life today and let the future take care of itself. For banks, this was a goldmine. Interest from millions of households produced steady, compounding profits. For governments, it created the illusion of endless growth, as consumer demand could be fueled by credit even when wages stagnated. For corporations, it guaranteed a steady stream of customers who could be enticed into spending money they did not yet have. Debt became the hidden engine of modern capitalism. And unlike selling physical goods, selling credit was infinitely scalable. You didn't need to dig a mine or build a factory. You just needed signatures, contracts, and the authority to create money out of promises. The danger, of course, was that the entire system became addicted to expansion. Banks didn't want debts to be repaid quickly. They wanted them to be rolled over, refinanced, extended. The longer people stayed indebted, the more profitable they became. Governments, too, learned that borrowing was easier than raising taxes. Politicians could promise benefits today and push the cost onto future generations. And central banks, with their power to create money, made it all possible by ensuring there was always enough liquidity to keep the wheels spinning. Debt was no longer a temporary bridge. It was the permanent architecture of the financial system. By the 1970s and 1980s, the consequences of this addiction were impossible to ignore. Developing countries across Latin America, Africa, and Asia had borrowed heavily in the boom years, encouraged by Western banks eager to recycle petrodollars after the oil shocks. When interest rates rose sharply under Federal Reserve Chairman Paul Volcker, these nations suddenly found themselves unable to service their loans. The debt crisis exploded in 1982 when Mexico announced it could not pay. The solution? More loans under harsher terms, managed by the IMF and the World Bank. Debt became a trap. You borrowed to survive, then borrowed again to repay, and with each cycle, you lost more control over your economy. Ordinary citizens faced austerity, inflation, and unemployment. Elites and creditors collected interest. Meanwhile, in the developed world, the financial industry discovered new ways to package and sell debt itself. Mortgages, car loans, and corporate bonds were bundled together into securities that could be traded globally. Debt was no longer just a contract between borrower and lender. It was a commodity in its own right, sliced, diced, and sold to investors everywhere. Wall Street became less about producing goods and more about engineering debt instruments. This process, called financialization, turned credit into the most important raw material of the modern age. The profits were staggering. A bank could originate a loan, sell it to investors, and move on to the next one, collecting fees at every step. Risk was supposedly spread around, but in truth it was only hidden, waiting for the next crisis to reveal it. The 2008 financial collapse was the logical outcome. Trillions in mortgage-backed securities, built on the premise that American home owners could never default en masse, imploded. Debt had been stretched beyond reality, and when it snapped, the entire global financial system trembled. Governments stepped in, not to punish the sellers of bad debt, but to rescue them, proving once again who the system was really designed to serve. Ordinary families lost homes, jobs and savings. Banks received bailouts. And after the dust settled, the use of debt didn't shrink. It grew. The very crisis created by debt became the excuse to create even more of it through central bank interventions and ultra-low interest rates. Debt, by now, was no longer just profitable. It was indispensable. Every part of the global economy depended on it. Governments funding deficits, corporations financing stock buybacks, households keeping up their living standards. Without constant borrowing, the system would collapse. Debt had become the product that sustained everything else, a product that could be endlessly sold, rolled over, and inflated. It was the perfect business because it required no innovation, no physical input, only the confidence of borrowers and the protection of governments. In the aftermath of 2008, central banks slashed interest rates to zero and flooded the system with liquidity, promising that this extraordinary medicine would restore stability. But what it really did was supercharge the addiction. Cheap credit encouraged governments, corporations, and households to borrow even more. The numbers are staggering. Global debt today exceeds $300 trillion, more than 3 times the world's annual economic output. Never in history has humanity owed so much to so few. And the irony is that this mountain of obligations is celebrated as growth. Politicians point to rising GDP while quietly knowing that much of it is simply borrowed from the future. Debt has become so normalized that we hardly question it anymore. A 20-year-old takes on tens of thousands of dollars in student loans, and it's sold to them as an investment in their future. A couple signs a 30-year mortgage, and it's marketed as a dream come true. Governments run deficits year after year, and voters barely notice because the consequences are invisible in the short term. Inflation is the hidden tax that makes repayment possible, silently reducing the value of money in people's pockets while preserving the nominal power of the debt system. What looks like prosperity is often just leverage stacked on leverage. And yet, the profitability of debt has never been higher. Banks earn interest on every loan, but they also create entire industries around the servicing of debt, refinancing, collection, restructuring. Investors make fortunes buying and selling sovereign bonds, betting on the creditworthiness of entire nations. Hedge funds speculate on distressed debt, profiting from the misery of bankrupt countries or struggling corporations. Credit rating agencies, supposedly neutral referees, become gatekeepers that decide who can borrow cheaply and who must pay a premium. Debt is not just a financial product, it is a marketplace in itself, where promises are priced, traded, and exploited. The most striking feature of this system is how it concentrates wealth. Every interest payment is a transfer from debtor to creditor. Over time, this funnels money upward, from millions of households paying credit card bills and mortgages to the balance sheets of the largest banks and investment funds. Debt doesn't just generate profit, it reshapes society, locking in inequality. Those with assets can borrow cheaply to buy more, leveraging wealth into greater wealth. Those without assets borrow expensively, trapped in cycles of repayment. Debt becomes a mirror of class division, polished and legitimized by the financial system. And now, as central banks explore central bank digital currencies, the next evolution of debt is already on the horizon. Imagine money that is programmable, traceable, and controllable at the code level. Loans that can be approved or denied automatically based on algorithms. Interest rates adjusted in real time, penalties enforced instantly. To many, this sounds like efficiency. But if the history of debt teaches anything, it is that efficiency for the creditor means less freedom for the debtor. The most profitable product in history is being upgraded for the digital age. And once again, it will be designed in committees and conferences far from the public eye. So what is the lesson here? It is that debt is not neutral. It is not a simple tool for progress or a natural feature of modern life. Debt has been deliberately cultivated as the most profitable product ever created, a product that turns time itself into money, that transforms the hopes of individuals and the struggles of nations into streams of interest payments flowing upward. To understand debt is to understand that financial freedom cannot be handed to you by the system because the system thrives on keeping you indebted. Real wealth means minimizing your dependence on borrowing, questioning the promises of easy credit, and recognizing that behind every loan offer is a machine designed to profit from your future. History doesn't repeat, but the pattern is always there. From the clay tablets of Mesopotamia to the mortgages of suburbia, from the Dutch bond markets to Wall Street's derivatives, the story is the same. Debt enriches the creditor, burdens the debtor, and reshapes the world in favor of those who control the flow of money. And the cruelest trick of all is that we're taught to celebrate it, to call it progress, to mistake borrowing for prosperity. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look. Subscribe to Invention Studio for more stories that cut through the myths of money, power, and history, so you can see the system clearly instead of getting trapped inside it.